that I believe are important that guide the evolution of IVL. The management actions that have been undertaken over the last few years have benefited the company and has grown the intrinsic value of the firm, as evidenced by the growth in operating cash flow of the company. The strategic blend of IVL businesses in Asia, Europe, and North America in diverse segments of feedstock, PET fibers, and specialties has strengthened the fundamentals and has allowed the company to deliver a 60% improvement over the vanilla integrated polyester chain company in Asia. I will explain this more in the further slides. Although the Asian commodity business has made 0% ROCE in 2012, IVL benefited from a 12% ROCE from the new businesses that were acquired in the last 2 years. I will discuss in further slides some additional information on our industry and our company, and my colleagues will explain in more details in their sections. Next. So, our analysis shows that the polyester value chain has a 5-year cycle. The current cycle, which ends in 2012, so between the period of 2008 and 2012, compare quite similarly to the cycle prior of 2003 to 2007. On the right-hand side, we have the Asia value chain margins, and on the left-hand side, we have the global value chain margins. We have split these margins into PTA, PET integrated margins and the entire value chain consisting of MEG and paraxylene. It is evident that the PTA, PET and fiber business in 2012 has seen its worst margin ever, as reflected by the green and red bars in the right-handmost column, and which has influenced the global averages as well. What is highlighted is that the volatility has increased in this last cycle. I think that we can expect volatility to increase in the future because the huge scale assets that are gaining dominance, which in a long market can continue to function due to their cost competitiveness, and on the other side, at times of outages, create an imbalance in the market and can lead to spikes in margins. Outages are a hallmark of chemical operations, and these imbalances and market leading to substantial margin escalations. So I think volatility is going to be more going forward than what we saw in the 2003 and 2007 period. Next. This margin analysis is based on still industry, but based on IVL portfolio. The left-hand chart is based on 2012 portfolio of IVL businesses and extended back to 2008. Across the cycle, margin based on 2012 portfolio for IVL should be $273. What we achieved in 2012 was $247. We saw peak margins in 2010 and 11, partially because of balanced markets, partially because of the cotton shortages, and partly because of outages in some significant plants, including Alpha Pet in USA. The right-hand chart shows the vanilla integrated Asian producer, a truly Asian integrated producer. And as you can see, the volatility in his margins would be higher than the margins that IVL derives. IVL's margin volatility is around 10% of the 5-year average and 20% from peak to trough, whereas an integrated Asian producer's margin volatility is as high as 40% from peak to trough and 20% from its average margins. Next. Now this chart basically explains that since 2009, when our EBITDA was 324 million and has grown to 453 million in 2012, has come more from the new assets that were acquired during this period rather than from the legacy assets. The 324 million EBITDA from legacy assets would have actually dropped to 192 million in 2012, representing only a 3% ROCE, had it not been for the strategic assets that were acquired by IVL in the last 2 years. The new strategic investments gave a ROCE of 12%, and the blended ROCE for IVL for 2012 was 7%. Even more important is our operating cash flow to net debt, which was comparable to 2009, which at that time was at 14%, and in 2012 is at 13%. During the finance section, Mr. Agarwal will explain this in more detail. So what happened in 2012? Our EBITDA dropped from 561 million to 453 million. We actually gained 36 million in volume growth from our legacy assets. We also gained 48 million from operational excellence and cost-saving projects. We gained $165 million from investments in new businesses. But the margin on the 2012 portfolio dropped by a whopping 70%, by $357 million. So what would have been a $600 million EBITDA business dropped to only a $250 million or $240 million business. But IVL's strategic actions, we were able to recover, this is what I mentioned in my opening slide, of 60% better than. So management actions returned 60% higher EBITDA, and therefore we had a final net EBITDA contraction of 20%. The 60% margin recovery, So next page. What were the challenges we faced in 2012? I like to think of 2012 as the worst year for polyester chain margins, and we were hit by a perfect storm. The new capacity build-ups of scale, very competitive assets of PTA in China, and the keen desire by producers to hold on to their market share led to a margin erosion, which has never seen in the past. It also dragged down the entire value chain margins for PET and fiber as well. Most of this happened in Asia markets. A spillover effect was felt in South Europe, and hence our joint venture in Otana suffered the most from this. But the current polyester chain margins are at an unsustainable level. We were also impacted by higher energy costs, higher manpower costs, and stronger currencies in Asia. The 2012 businesses were still recovering from the flood impact in Thailand, as well as the typhoon impact on Alpha PET, which impacted our utilization rates. I believe that this unsustainable level of margins is going to lead to significant rationalizations, and with these rationalizations, which we see happening already, we believe that the PTA spreads should come back up to $150, which is very, very near to the 5-year average margins of the last 5 years, which was $160. Mr. Ladda in his industry presentation would show you why we think $150 is a potential margin in the next years.